Good afternoon, everybody here on the East Coast. Good morning to those um, in a different time zone. Welcome to the Lear October 2025 Strategy and Market Update. My name is Tom Steinley. I'm Managing Director of Business Development at Lear. I'm joined by Jim Warner, who is Co-Portfolio Manager and Director of Research at Lear. A couple of reminders. Please ask questions and do that through the Q&A button at the bottom of your screen. And at the conclusion of the meeting, after we send the slide deck and the video through compliance, I will be forwarding it to everybody on the call. And that is, as a reminder, client approved if you want to distribute that to clients or prospects. We have a lot to cover today. There's a lot going on, and I think I want to turn it over to Jim as soon as possible so that we can make sure that all your questions are addressed. So please ask them throughout the presentation. All right, Jim, all you.
All right, terrific. Let me pull up, share my screen. All right, great. So there's been obviously a lot of talk in the media recently about whether we are in a bubble and whether this is 1999. So I'm going to spend a few slides up front talking going through that narrative and basically disproving it. This is not 1999, nothing close to it. There are a couple of similarities, but we'll go through those and we can obviously take some questions on that. So the first thing that these bears say is that, oh, the sky is falling. Look at the valuation of the S&P 500. It's right at where the dot-com crash was before that happened. And now we need to also understand that where these bears are coming from. These are the same bears that were wrong about stagflation. They were panicked about the tariff-induced inflation. They were panicked about declining GDP growth. Remember, that was negative in the first quarter. And then most likely these folks never got back into the market. Now they're chasing and the market continues to go up. So of course they have to assign new blame. And the new narrative is the new Chicken Little narrative. If you remember back to your childhood storybooks, is that it's 1999. And it's entirely driven by this chart on valuation. So, okay, so let's take a look at, well, how does the S&P 500 look today versus 1999? And what you'll come to find is that it's apples and oranges. So what I put together here is two tables. The table on the left are the top 10 holdings in the S&P 500 today versus the top 10 holdings at the peak of the dot-com bubble in March of 2000. And the first thing that you'll notice as you go down through these lists is that the first thing I'll point out is that the top 10 today account for 40% of the entire index versus only 17% back in 2000. Now this matters because the direction of the market has been incredibly dictated by the top names, as we all know, right? We talk about things like Mag 7, but really for the last several years, it has been the largest names whipping around the market, and their fortune basically dictates the fortune of the rest. So that's the first thing I'd point out. The second thing is there's much more technology exposure today than there was back in 2000. So if we just look through the list on the left, today we have NVIDIA at 8% of the S&P, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, Tesla. That's a tech company, right? And then you round it out with Berkshire and JP Morgan, and JP Morgan is becoming more of a tech company with each passing day. In comparison, in March 20, you had Microsoft, you had Cisco and Intel, but you had GE, Exxon, Walmart, Citigroup, Merck, Pfizer, right? These are totally different businesses that are lower growth, they are higher cyclicality, and therefore naturally deserve lower multiples. Or flip it around, the content of the top 10 in the S&P 500 frankly deserve higher multiples. So let's not going back to that first page. This is not an apples to apples valuation reading by any stretch. The last thing I'll point out is that the top 10 trades today are trading at a 17% discount, looking at PE, trailing PE, to where the top 10 were in March 2000. So if there's a bubble going on in the S&P 500 relative to, and you want to compare it to the dot-com bubble, I don't think there's a comparison. Let's actually take a look at the actual dot-com bubble and what really drove things. Because the reality is, a lot of people who are investing today weren't around then. I was, and I lived through it. But basically, if you recall, the NASDAQ bubble was essentially a function of the fact that the internet was getting commercialized, that e-commerce was coming onto the playing field, and that we needed a whole new infrastructure, telecom infrastructure, to support it. Kind of sounds a little bit reminiscent to what's going on today, right? Which is where you can get trapped. But where we have AI being developed and an AI infrastructure to support it, it's a similar thing, but don't get trapped. What happened, obviously, you can see it in the chart here of the NASDAQ, which was very internet and telecom heavy, is that it rose 300% from 2007 from 1997 until March 2000. Those dates are wrong. I'll correct them on the next version. And then they declined nearly 80% before bottoming in October of 2002. So, just absolutely incredible rip. And then a complete elimination of all those gains. Now, why did that happen? That happened because the dot-com fiction of the future eventually met earnings reality. And what do I mean by that? Well, the earnings expectations during the dot-com era never ever came close to reality. And just as one way of showing this is the growth expectations in the S&P 500 versus what actually happened. And if you run through this chart with me, in 1998, the street thought that S&P earnings were going to grow 7.5%. They fell 64%. In 1999, analysts out there thought that earnings were going to grow 21%. They fell 30%. And in 2000 is kind of where we had the beginning of the year, the ultimate collapse. But even as we went into 01, 02, again, the earnings estimates were just way higher than actual reality. And so this is what ultimately drives stock prices, right? It's large deviations from expectations. And in this case, in the dot-com world, there were large negative deviations. And that's why you had that punishing 80% decline. So what were the key characteristics that caused that collapse? Well, the first was a speculative IPO frenzy that brought many companies with zero cash flow and in some cases, zero revenues public. In many cases, these were startups that frankly didn't even know how they were going to generate revenue. They sort of had an idea, but they certainly didn't have any cash flow. In fact, if you remember back then, we were valuing companies, or not I, but the market was valuing companies based on eyeballs and clicks, not earnings. And in fact, what ended up happening is that these eyeballs and clicks never translated to earnings. And so as many of these internet companies, these e-commerce companies like pets.com, everybody remember the pets, sock puppet, I put them out there on the right. They were burning cash and they had no path to profitability. And so ultimately that meant that they were going to have to raise money. And in order to raise money, you need to show that you actually have a viable business model. Of course, what ended up happening is that they didn't. Now, this also led to a complete overinvestment in infrastructure. And here, too, is where people try to draw the analogy to today, where there's, hundreds of billions and soon trillions that will be invested annually in AI infrastructure. And I'll get to that here in a second. But I'm going to warn you again that that's not the same. So the media and analysts, there was tons of hype back then. If you remember, there was, retail investor mania. But in the end, over 300 of these dot-com companies went public during the period leading up to the bust in March of 2000, and approximately 50% of them went bankrupt, and another bunch were sold ultimately at incredible discounts to their original IPO values. So obviously, this was a business plan or business model problem that caused the issue that caused the dot-com crash. Now, today, this AI-driven cycle is something very different. The global CapEx projections for AI development are unlike anything we've ever seen before. This is a chart of the global hyperscaler AI CapEx projections And of course, these seem to be changing almost on a daily basis. But it's a compilation of company disclosures and what McKinsey's put out there. But and it's probably inherently wrong, but it's huge, as you can see, going from maybe just a little over 200 billion today to potentially 1.5 trillion dollars a year 10 years from now. So in other words, there's still a lot more coming, and this is really a big differentiator between what's happening now and what happened during the dot-com years, was that it's being funded by the largest, most profitable companies that have ever existed, right? These are Google, Microsoft, Meta. These are companies that are not reliant on venture capital. They aren't even, frankly, reliant on debt financing. And so the funding sources behind all this CapEx are incredibly solid. Now, there will be others that come to market, particularly in the debt world. Oracle recently came to market um, with an $18 billion deal, and it was oversubscribed by 8x. So it just tells you that there's a lot of appetite out there for funding this build out. Nothing like what we saw at the dot-com boom. Now, one of the key issues that I'm sure most of you are now aware of is that, and this goes to our electrification thesis that we've had on now for 2 years, is that AI data centers consume huge amounts of electricity. And there's going to be more of them, as you can see from the CapEx on the slide before. And so the real issue here is going to be, is there sufficient power? That will be the critical bottleneck. And this is not just oh, we need to deal with this at some point in the future. This is an immediate and emergency need to expand power generation to meet AI demands. Currently today, there's 6.4 gigawatts of data centers under construction, with 46 gigawatts more planned. And this is all on top of what's already out there. That's an extraordinary amount of energy that is required. So what we're talking about here isn't just some cute little dot-com, like I can sell pet food on the internet type trend, to a broad tsunami of demand that is radically changing, it's radically changing whole industries. And we haven't even begun to scrape the surface on that change. But in the near term, what's it doing? Well, it's creating enormous demand, as we know, for chips, GPUs, MPUs, memory, ASICs, data center components, cooling, generation, racks, wiring, electrification, generators, right? What they're finding is that they can't just plug into the grid. They need to be able to have their own natural gas generation, so they need their own turbines. They need solar panels, and what they're really going to need, I think, in the course of the next few years are fuel cells and batteries. There's going to need to be a massive upgrade in the grid. All these things you've heard about. Utilities. Utilities are going from boring companies to growth companies. So these are really exciting times. And of course, all this stuff uses really critical commodities such as copper, uranium, natural gas, obviously rare earths as well. So we are sitting really in the second inning, I think, of this massive wave of future demand. And in many cases, a lot of these components have supply constraints. That'll be the only thing that holds it up. And so these are sort of the key things that have factored into some, but not all, of our outperformance this year, is understanding how this ecosystem is evolving. And of course, as I've said, we've been there for quite a while. So, and everybody else is just now catching up, I think. So, I mean, let's step back and let's talk about what does this mean? Okay, these are big numbers, but why are the hyperscalers spending so much? Why is AI so important? So let's break it down into what's really happening. The future is very large, very fast-growing markets today. So, and going back the last 3 to 5 years, really, what you've seen and you've heard mostly about in terms of AI are these large language models being trained up by the large hyperscalers in very large data centers. And once that training has happened, we have now moving into inference AI. Inference AI is the application to, say, our business or to a call center's business. How do I take what's been learned by these LLMs and actually apply it for real world decision making, research, and analytics? And we have literally only scraped the surface on what's possible. I know that daily we think about how can we use it for better portfolio management? How can we use it for better client service, et cetera? How do we use it even in our research process? And we're just an investment firm. Think about what a manufacturing company could do, or someone with a complex supply chain. We are just beginning to see this and this is what when I talk about the breadth and the broadening of this AI tsunami, it will start to catch up a lot of other industries that don't just sort of pop into your head as AI, right? It's the application of AI. That's what we're moving into. In 1 to 5 years, we're going to be talking about physical AI, and we're already starting to invest there. This is anything from, you can see it in like the Meta glasses, but VR applications like that. We'll see it in autonomous driving, where you've heard that Tesla is now doing robo-taxis in Austin. There's Waymo in San Francisco, that sort of thing. That's another application of AI. And then we're going to be moving into IoT. So imagine a world where there's a security camera, and it's not some dumb security camera feeding something back to some guy sitting behind a monitor who then has to interpret what he or she sees and do something about it. It could call the police. It could put down another door to protect some valuables. It could, enhance security. It could turn on lights. It could do a whole bunch of things beyond simply what it does today. It has many other applications, of course, as your mind wander throughout manufacturing and other industrial uses. And then finally, we'll get to humanoids. Imagine a factory where you have workers that work 24/7, 7 days a week, 365 days a year, and they don't complain, and they're really cheap. And that's where we're going. And then look out another 5 to 10 years is quantum computing, which promises extraordinary additional computing power, which will take all of this AI and just magnify it into applications that we haven't even begin to think about. But this is the perspective you need to have when you think about, is this 1999? No way, no way in shape or form. There are, yes, some stretched valuations here and there, but the applications and real world money making, earnings generating applications that can expand margins for companies, can introduce new revenue streams. We are literally in just the first or second inning of that. Now, let me give you just another perspective on the valuation today of the S&P 500. So what I did was I decided to split and look at the Russell 2000 growth index versus the Russell 2000 value. Because obviously what happened during the dot-com boom was we had this big surge in just, in tech names, right? And tech and internet infrastructure names. And today we're seeing a big surge in AI names and AI infrastructure names. But where are we when we really look at sort of generally growth companies and generally value companies? And what you can see is that, yeah, those valuations are up above their medians, but they're not at dot-com highs yet. And so in the Russell 2000, which really was the kind of the epicenter of the dot-com, that spiked all the way up to 43 times earnings. Today we're at 30. And frankly, back then, as I said, there really were no earnings ever coming. Now there actually are earnings that are going to be generated by the application of AI and probably on an accelerated basis. That should frankly bode even higher multiples. And what about the value? Well, you say to yourself, well, obviously the value didn't rip during the dot-com. It sort of, kind of got lifted. All boats got lifted as the market went up, and then it went down as the market went down. But really, value has sort of been trading in a range. But as I just said, one of the most interesting places to look for the next great ideas in investing are these boring value companies that with the application of AI become not so boring. And we've already started to see that in certain places. So, there's the whole economic side of things and the Fed updates. Let me touch on that real quick. Because obviously we have a Fed that is now starting to ease. And we've gotten, even in spite of the federal government shutdown, which meant that we didn't get monthly payroll report last month, we still got the ADP payroll report, which I have told you that I think is probably more applicable to what's going on for financial markets than maybe what the government's putting out. But as you can see from the chart, that there's weakness. There's been continued weakness. And we'll have to obviously see how this goes. But this is something that would cause Fed members to think about cutting again. So it's very clear that, this is something that's worth watching. I do think that there's a lot of noise in overall payroll numbers. There's obviously federal government layoffs. There's ICE deportations, which is frankly disrupting a lot of businesses. Ask anybody who's in the dairy business, where they get a raid on their facility and they lose 70% of the employees, which, by the way, had been e-verified through the government system, but somehow, whether it's fraud or another bad government system, these folks weren't caught. But the reality is, there's a lot of noise, and we just don't know how it's going to play out. But we're continuing to watch that very closely. AI too is creating job weakness in the tech sector. What about inflation? Well, it's still a little bit elevated, but there's not really been a tariff spike. And whatever spike there's been or higher price pressures, the economy appears to have absorbed that fairly well. Now you might say, well, you know, it's still coming. Well, I don't think economy really works that way. The initial shell shock of the tariffs, we're now multiple months into it. Yeah, maybe there's more to come. But where would you see it? Most likely, you'd see it in core goods. Core goods CPI on the left, chart on the left, you can see it's creeping up, but it's at 0.3%, well below the 2% target that the Fed has in mind. And part of what's going on is that the pull forward of goods demand during COVID, when everyone was at home, basically created massive inflation. And we've seen essentially deflationary effects as that pull forward effect has been absorbed and the economy adjusts to it. And so now it may just be mathematically easy comps that are driving this higher growth in CPI. But at this point, it's de minimis, so I'm not going to spend any more breath on that. More importantly, I think, is what's going on in CPI core services. And I'm looking at it ex shelter. As you know, shelter is a weirdly computed notion. It has been declining. It's still in the high 3%. But let's just strip that out because it's frankly not reliable and it's not really reflective of reality. Certainly not if you live in Dallas or in Florida. But in the CPI core services less shelter, you can see it's sort of stabilized out. There was a slight tick up in July. Some of this, frankly, indicates that the labor market is a little tight, which is actually a counterbalance to the weak labor numbers that we're seeing. In other words, what seems to be happening is that companies don't really want to fire workers, but they also don't really want to hire them. And so we have kind of this stalemate right now, which is causing wages to stay a little elevated. But we're going to continue to watch this. So you sort of have this negative sign from the labor market. If you're thinking about you're the Fed governor and you want to cut rates, the labor market's giving you an excuse to cut rates, but inflation is still, there's still some question marks around, still elevated at least. Nevertheless, we still think that the overall Fed funds rates is probably still about 100 basis points too high, higher than neutral. Okay, so we're still in restrictive territory, and I think there's plenty of indications that maybe you could take it down a little bit. So the market is basically pricing in a very gradual migration back to that sort of 3% neutral rate over the course of the next year. There's a full 25 basis point cut reflected in the upcoming meeting here in a couple weeks. And there's also another 25 bips pretty much priced in for the December meeting. I'm not 100% sold on that, but I think generally the trend overall is down, but not at any egregious rate at this point. So somewhat, I'm sort of in generally the court of Fed futures. Maybe I think it's a slower cut, but the reality is that I don't believe that there's any risk to higher rates. And as such, we're in kind of this mode of don't fight the Fed. I wrote about this in my newsletter last, a few weeks ago, but in the I don't know, dozen times before where we've had Fed cutting and the economy isn't in a recession, the market goes up, and the economy continues to hang in there. So, this at least indicates to me that we still have a green light from a market standpoint, at least as far as the Fed's concerned. And then, oh, by the way, GDP does remain strong. So, some of the bears and the naysayers, they looked at the 1Q negative 0.6 GDP print and said, aha, that's the issue. And of course, what we know is that was a tariff-induced import surge. GDP bounced back resoundingly in 2Q at 3.8%. And now the Atlanta Fed, which albeit is never right and sometimes a little too high, is projecting 3Q GDP growth of 3.8%. I mean, anything around that, even a 2.8% number is indicative of a solid economy. So so the economy is not falling apart. All these fears about tariffs inducing a recession, et cetera, or inflation going through the roof and interest rates going through the roof, all wrong thus far. Now, what happens as we go into 2026? And I've mentioned this before, but 2026 will benefit from deregulation that's already in the works, lower interest rates, certainly year over year, stimulus that came from the One Big Beautiful Bill, and don't forget the $3 trillion of announcements by large international companies and even some countries to invest in the United States. So right now, the tailwinds for GDP growth remain very strong. So how does this play into portfolio strategy? And we get a number of questions. And frankly, I want to touch on maybe one of the most important ones later, but which is how are we outperforming? And honestly, I've already written about this in our newsletter, but I'm happy to address it again. But let me address some of the other questions that we're getting to first. First, can the market keep going up? The answer is yes. There's a favorable Fed. There are powerful themes that are secular and, as we talked about, that are powering a lot of the economy. And investors need to chase. There's a lot of investors that have underperformed this year because they were too negative. And so, yes, the market can keep going up. It also, by the way, can also pull back 5 or 10%, which is also totally normal, and yet not, eliminate any of the reasons why we think things are good and going well. So, yes, pullbacks are totally normal. And if it becomes a pullback that is what I call fundamental, not just sentiment driven, fundamental nature, like something really broke in the labor market, or something really happened in inflation, or I don't know, whatever the next deep seek moment, then we would de-risk like we do all the time. This is the beauty of the way we invest, is that we aren't static. We're constantly moving and dodging punches that are being thrown at us. And so oftentimes some of the biggest ones you don't see coming, and nobody does. But it's our ability to de-risk very quickly, which I think we have shown over the last 10 years is one of our hallmarks. How long will the AI trade last? As I said before, I think we're in the second inning. The AI tsunami is broad, but we're also not dumb. We've been banking profits. We're sticking to our we're sticking to our models. We're sticking to our price targets. Where we see exuberance, we trim. What is going on with Bitcoin miners? Aha! I have a prop. So we just received our hard hat from Irene, one of the Bitcoin miners that we own in Global Vigilance. The stock is up 5, 6 times since we bought it. Depends on when the client joined us. But this has been really one of these hidden gems in the market. They own the dearest asset, which is data center capacity. What is a Bitcoiner? A Bitcoin miner, they literally have an expertise in building data centers. And right now, there ain't enough data center capacity. And so they have gone from overlooked, miners with very terrible valuations to very attractive data center companies that have very long-term contracts or hope to have long-term contracts with names like Google and Microsoft, et cetera, et cetera. But we've been trimming here. We're not dumb. When things really work, we trim. Will gold continue to go up? Gold, as you all know, has been another incredible outperformer. We've owned a lot of it. We've owned it for years. It has been an incredible hedge against a weaker US dollar in particular. And so long as the central banks keep devaluing fiat currency, it probably will continue to work. And it plays a very important role as a hedge in our portfolio. Somebody asked me recently, do you, oh yeah, you guys have outperformed, that's great. Do you guys ever hedge portfolios? We don't short or buy covered calls. Our hedges are gold, cash, and exposure to uncorrelated assets. Look, there's nothing more powerful than just going to cash if stuff starts hitting the fan. Covered calls, it requires timing, it's expensive, it doesn't generally work. We can't short by definition. And then exposure to uncorrelated assets like gold, for example, is just one of the many reasons that we can create a portfolio where not everything's correlated to each other. And that really helps in times of when the market's being pressured. The other interesting thing that I point out is someone asked me recently, when do you tax loss harvest? And the answer is all year long. All year long. It's an important part of our risk management process. In fact, the problem that we have this year is that we frankly don't have a whole lot of losses to take. But when we do get them, we take them and we reinvest that money appropriately, oftentimes in that same theme. But it is a very important part, particularly in years like this year where there are a lot of gains, that we harvest losses whenever we can get them. So I want to just review, because sometimes when you hear messages like this, that you think, oh, all they invest in is artificial intelligence and data center construction. Nope, that's not true. We invested in cybersecurity. In fact, we just had a takeout in that one. We're investing in what I'll call modern warfare theme. This is drones. This is solid state rockets. This is hypersonic missiles. This is anti-drone defense, things of that nature. We invest in mission critical commodities. Liquefied natural gas we've been invested in that since 2019 when I wrote a paper on LNG and the importance that would be for the economy. We also like big brand turnarounds where you've got a brand like a Brinker, like that owns Chili's, that needs to turn around, and they put in smart management and they pull it off. It's something that's completely unrelated to generally the market and certainly technology names. We are big fans and believe in what's going on in terms of deregulation in the financial services industries, and I have a number of positions there. And then India. Nobody ever talks about India anymore, it seems. And I'd even add in Japan, but these are interesting ways to further diversify the book away from, what is, chiefly driving the market. And then lastly, I'll just talk about like Ethereum and just sort of crypto in general. This has become, I think, a greater focus of ours more recently. It's very clear that the administration is behind crypto and the development of it. There's a big move now for adopting blockchains that are settled in, with Ethereum. And this is something that you'll probably hear us talk a lot more about in the coming months. So real quickly, let me just review our top 4 strategies. So Tilt, which is our most aggressive, is now up almost 42% gross for the year, 40% net. This is the things that it's invested in, the infographic on the right. I won't, we'll be distributing this. We can go into whatever you want, but there hasn't been a lot of changes month over month. In our flagship Global Vigilance Moderate strategy, it's remained around 58% equities, 30-ish% fixed income cash, 11% commodities. A lot of that is gold, a little bit of copper, some uranium. But it's up now over 30% year to date, 29.4 net of fees. So, even our moderate, which still has 30% fixed income, is blowing away the S&P. That doesn't always happen, by the way. It's just we've had a lot of really great stock picking. A lot of our themes are working, and we were there. We waited. The market came to us, and so that's just how good investing works usually. So, and then even our Global Vigilance Conservative, which by the way was just awarded 5 stars by Morningstar for virtually every period that it's measured, is up almost 26% year to date. So, and we can talk all day long about the risk associated with it, but I put out a paper recently that analyzed all these returns, and essentially by far our outperformance is being driven by idiosyncratic alpha. And essentially you can read that to mean good stock picking. And then finally, I'll just touch on our strategic income portfolio, which is kind of our way of providing a higher yield to conservative investors without taking the credit risk inherent in owning high yield securities or that benchmark. And you can see that it's doing pretty decently this year as well. So let me stop there, Tom, and let's take some questions.
Great. Thanks, Jim. As always, that was fantastic, very enlightening. Please, just a reminder to everybody, please ask questions. if you have them. That's what we're here for. Yeah, the first one, Jim, is have you heard anything about data centers actually needing less energy than originally expected?
Yeah. So in technology, there is always a movement. Always a movement underfoot to make chips that would consume less energy, to make cooling systems, to make chips that produce less heat and therefore less electricity needs to be spent on cooling systems. That is just sort of an underlying default progress that is being made. But the reality is what's really driving the consumption and the explosion in consumption is not only usage by all of us of AI, but when we do that, it creates this incredible explosion in tokenization. So essentially what it does is it takes down our prompts and it sends out tons and tons of different queries around the internet. And that tokenization in processing the information is what's just absolutely exploding. So until that stops exploding, we're not going to see a situation where data centers are, in some way underutilized, which would then drive the need for less energy. But yeah, I mean, I would certainly assume that like over the course of the next few years, we might find, each new chip that will come out will consume less energy, will consume less power, but it's just the magnitude of what's being used and create in terms of the demand that is what's driving this power, this power hungry situation.
Got it. What about the government shutdown? Does that have any bearing on potential market risks or anything to do with a reallocation decision that we need to make as a tactical manager?
Yeah, it's a good question. I mean, honestly, it's largely being ignored. There's not really anything that, where it could it possibly impact us would be in new contracts being awarded to some of our defense companies that we're invested in. But actually, we've been seeing a pretty steady stream coming out regardless. So, look, if this shutdown is just, a few weeks, the market's handled that before. The economy handles that, without really batting an eye. If we're talking months, then that's maybe a different story. But, honestly, what's the big trends that are going on out there are really not impacted by the government shutdown.
Okay. Are you worried that the market is too high? I mean, I know you went through the valuation difference between where we are today and the dot-com bubble, but is there any concern that the market is too high?
Well, like I said, there are, if the question is do you think the top 10 holdings in the S&P 500 are too high? One might say, yeah, maybe, or maybe they're stretched. I do think that we're kind of looking at, the old Mag 7 is, well, they had their day, and now maybe it's time to look elsewhere. And there's plenty of places you can look where valuations are, very attractive. And again, the point here is that on an individual stock basis, because look, we don't buy the S&P 500. We don't own ETFs. And frankly, this question is actually, frankly, not that relevant to how we think about investing because somewhere in the world, there is a really interesting stock that has a really interesting secular theme that is powering their earnings forward. And a lot of investors have not figured it out yet. And so we still think that there's a lot of that out there, regardless of, what the actual aggregate index does.
Just one more question. I talk with a lot of advisors, and it's clear that two of our top themes are electrification, the power needed for AI advancement, and then AI itself, cloud computing. Do we have, I mean, those are two of the largest themes in terms of percentage of the equity exposure in our portfolios. Do we have any internal limit as to how much we will put in any one theme? Is there anything in our portfolio management process that limits adding too much to one theme?
Of course. I mean, we have risk parameters like any other firm would, and they're frankly in our intro book. You're welcome to go take a look at them. And any good portfolio management and portfolio construction, you never want to get too exposed to one particular theme. And so it's, while those are large themes, we have many others that are also that sort of diversify away that risk.
Mhm.
Like Indian banks have nothing to do with AI, MLPs have nothing to do, only very tangentially have something to do with AI or electrification. LNG exports, or Cheniere exports LNG to Europe, and that's really, you know, very tangentially related. So yeah, in our financial services bets, whether it's mortgage REITs, whether it's brokers that benefit from deregulation. I mean, these are things that are just that are all throughout the portfolio, and frankly, create diversification. I mean, I would argue that like if you really looked at the S&P 500, those top names, and you added up the percentage that's Nvidia, that's Microsoft, that's Meta, right? It comes out to be a huge percentage of the average investor's portfolio. And frankly, I think we've just done a better job of expressing kind of a similar weighting that everybody just inherently owns in the S&P 500. We've just done it, I think, with better names.
Great. Very good. Once again, if you do have questions as a follow-up, please reach out to Jim or me or anybody on the Lear team. And within a few days, I'll have the recording and the slide deck for everybody. And once again, thank you for joining us, and thank you for being a valued partner. And we'll see you next month. Thanks,
Thanks,
Jim.
everyone.